David Rosenberg, nice to see you on a lake in Maine.
And it's a wonderful day, and thanks for inviting me on.
Sure. Now, you're kind of a positive guy these days. I don't know if it's because you're out fishing, but you're feeling pretty good about the stock market, which is a reversal from how you used to feel.
Well, a reversal maybe from how I felt, 4 or 5 years ago, because I used to be in the double dip camp, which was not the right call. Bottom line is this. We are ripe for a correction. Corrections come and go. We haven't had one in 4 years. But when you're talking about fundamental bear markets in the stock market, they only occur under one scenario, 100% of the time, and that's when you have an outright recession in the economy. So when I was bearish in the past, I thought the economy was so fragile that it wouldn't take much to cause us to go into reverse. But we emerged from the problems we had in 2011, 2012, whether it was financial sector re-regulation, or whether it was Obamacare, or whether it was the dramatic slowdown in global growth. The U.S. economy has been extremely resilient. It's not an economic boom, but this is proving to be one of the longest economic expansions since the Civil War. So what we haven't actually experienced in terms of the veracity of this expansion, we've experienced in terms of duration. So I call it the no boom, no bust economic growth cycle. The stock market is overdue for a pause, and I would say even a correction, but I think that'd be a great buying opportunity because the next recession, and there will be a recession at some point, looking at the tea leaves as I see them right now, is at least 2 or 3 years away.
But how much room does the stock market have to run? Because you know the game, right? Markets hit new levels, and while some tech stocks have pulled back, then people start saying, oh, historically the PE looks a little high, I'm worried about valuation. So is all that potential growth over the next couple of years already priced into the market?
Well, price earnings multiples are a very poor indicator of the direction of the stock market. But what they will do is act as a brake in the stock market. So I think that the returns you're going to get going forward in equities are going to be somewhere in the mid-single digits. So we're not talking about 10-15% growth in the stock market like we've had already. And I think, as you said accurately, the low-hanging fruit has been picked. But the multiple itself just constrains, doesn't reverse, constrains the upside potential for the stock market. I think that when people talk about, well, we have a price earnings multiple of say 16, 17, 18, and this is where it's been in the past, is to me a purely fallacious argument, because what you want to do is you want to take a look at where is the multiple at this stage of a long expansion compared to where the multiple is in previous long expansions. So it's not about where the multiple is compared to the past, it's where you are at this stage of the cycle. And actually, if you take a look historically, the multiple where we are right now, already past the 6th birthday of this economic recovery, is not outlandish. I'm not going to forecast that the multiple is going to expand further from here. It probably won't. But I think that earnings and revenues are going to take the next level of the market to new highs. And it's not going to take much to go to new highs. We're only 2.5% below where we were before in terms of the all-time peaks. So the bottom line is this. You can pick up a 2% plus coupon in the bond market. You can get 0% in cash. Maybe if the Fed raises rates, maybe you'll get a quarter or half. The stock market already has a dividend yield of, call it roughly plus 2%, and earnings are going to grow mid-single digits. And I think this market will go up with earnings. So it's not going to be 10, 15, 20% equity market appreciation. It's going to be more like 5, 6, 7%. So people have to adjust their expectations. But that still isn't a bad return when you consider what the alternatives are right now.
Is there any particular sector that's either undervalued or overvalued when you look at the market as a whole?
Well, I would say that there's no specific part of the market that looks cheap right now from traditional valuation metrics. But I'll tell you what I do like. There's segments of the financials that I like. I like fund managers. I also like, look, the regional banks right now are breaking out. Bank lending growth is accelerating. If the Fed raises interest rates, it's going to give the banks a certain level of margin. So the financials are looking good. I would say that consumer cyclical services, okay, whether it's media or entertainment or cable, I think cyclical services are actually looking very good in the consumer space. Those are the areas. I think healthcare, you got to be careful with biotech because they're speculative and very expensive. But healthcare, is demographically going to be a great area to play in terms of growth if you have a long-term view. So I would say healthcare, I would say financial services, and I would say, look, the U.S. consumer is looking to be right now in pretty good shape. You look at the employment numbers, income broadly speaking is starting to pick up a little bit. Balance sheets have improved dramatically this cycle. So there's segments of the consumer spending space in the U.S. that looks particularly good right now.
All right, I saved the toughest question for last. Are you a better forecaster or fisherman?
Well, I would say that my fishing skills are totally inadequate, which is why I don't even have my worm in the water. So all I have to do is really just bat 250 in my forecasting, and I'm doing a heck of a lot better than I am on fishing.
David, thanks so much.
Thank you.